stressed on tax continuity and certainty. It has also called for stimulating private investments and incentivizing companies that generate employment opportunities. So what else is on their wish list? Let's ask the experts themselves. To take the discussion forward, I'm now joined by Pranav Sayta and Saurabh Agarwal, tax partners at Ernst & Young. And straight away coming to Pranav first, because direct tax is something that has seen a lot of changes. We saw a new act coming in altogether. However, rules are still awaited. And when it comes to tax certainty, well, everyone has been talking about tax certainty. And what is it that you want the government to look at? What kind of certainty are you looking at when it comes to direct tax side? Because we've seen the regime becoming quite stable when it comes to corporate or the personal income tax side. So what kind of certainty is it that the industry is now looking at from the government?
Indeed, Timsy. So as you rightly said, the government has been doing a lot in terms of providing more certainty, clarity, reducing litigation, and so on. One of the steps that they have taken, therefore, is introducing the Income Tax Act, the new Income Tax Act 2025, which will go live from April 1 this year, 2026. And what we are hoping is that the government provides clear guidance on the transition provisions as we go ahead, clear set of rules and forms which are still awaited, and maybe some form of FAQs to ensure that when one moves from the current 1961 Act to the new 2025 Act, it happens in a seamless manner in terms of the transition. We are also looking at certain anomalies in the current Income Tax Act, which probably could be clarified. Like, for example, under the 61 Act also, demergers were tax neutral so long as they fulfilled certain conditions. So also in the 2025 Act, but there's some change in language which results in some form of confusion. Whether a fast-track demerger, which has been particularly promoted by the government in terms of its effort to enhance ease of doing business, whether that would qualify for tax neutrality, whether buyback of shares will entirely be regarded as deemed dividend, allowing no deduction for cost of acquisition to shareholders, whether employees receiving ESOPs, irrespective of whether they are in startups or in other companies, can defer the taxation to when the liquidity event happens, when they actually receive the monies on sale of the shares, and so on. So there are several points on which we are hoping to get some clarification, some certainty, even in terms of acquirer of shares today, because of an anti-abuse provision that has been introduced. If shares are acquired, for example, at a price which is less than the fair value as per the prescribed rules under the income tax, then that shortfall, the price at which the shares have been acquired by a buyer and the prescribed fair value, that discount is deemed to be income in the hands of the buyer. Now, those prescribed rules are under the new Income Tax Act yet to be prescribed, but one is hoping that genuine
that's what I was, Pranav, I'll interrupt you there, because all of that that you are talking about is actually parts of the rules which is expected any time. To be precise, already they were expected last calendar year, and now we are expecting them to come out shortly. So a lot of this, I believe, government is looking at and is considering as part of the rules, isn't it? Didn't you get that kind of a feedback from the government?
No, I'm not too sure they are considering that. We have represented, of course, and many of these require changes to the law. For example, the section 56 to 10 in the hands of buyer of shares, bona fide genuine transaction should not be covered, is required through an amendment to the law. Similarly, fast-track demerger, a clarification or an amendment to the law by way of, clarifying that fast-track demergers will also qualify for tax neutrality is required in the law, so that a demerger under 233, section 233 of the Companies Act should also become part of the relevant provision under the Income Tax Act for demerger. So many of these require actually amendments to the law as well. Some of them, of course, can come even through a clarification by way of a circular or a rule. But ideally, most of them will require an amendment to the law itself, which can happen best under the budget provisions.
Yes, as part of the finance bill. Coming to Saurabh now on the indirect tax side. Customs dispute resolution is on your wish list, something which the industry has been demanding for quite some time. How would you place it on your wish list, and what is it that you are hearing back? What is the feelers that you're getting from the government? Saurabh, you're on mute.
I think, Timsy, for the last 3 years, it has been on our wish list. And the reason being precisely, when you look at once the GST was rolled out in 2017, majority of the state VAT departments, they have come up with a dispute resolution or a so-called as amnesty or a settlement scheme, followed by which we have seen even under the GST law, some sort of a relief was given in order to bring down disputes last year. When we look at subsequently, even under the Income Tax Act, there was a Vivad Se Vishwas scheme which has come. But as far as the customs are concerned, it's long time since when lot of disputes are pending before various tribunals, before various courts. And many of these disputes are of a small number. And the way that this government has been looking at, the policymakers' thought process has been very clear that they want to bring in certainty of taxes. They want to bring down the number of disputes. And we have seen it happening by way of issuance of clarifications, by way of issuance of circulars, by way of amendment in laws as far as GST is concerned. But as far as customs is concerned, this has been a big time ask of the industry. And the way when we look at the focus is on making a self-reliant economy, promoting manufacturing. So at least as far as the past is concerned, I think some sort of dispute resolution for one-time settlement of disputes is something which industry has been watching out for. And we are also looking forward to hear from the
And I must say, it is not just EY. Every industry chamber, every big four is asking that the industry is waiting for a dispute resolution mechanism, be it in indirect taxes or indirect taxes. So something that or across the sectors, every industry is asking for this. Coming back to Pranav again, on the TDS side, a lot of rationalization has happened on TDS. We saw some rationalization happening in the last budget also. What is it that you're now looking for on that front? Because that again features on the wish list of the industry.
Sure, Timsy, a very good question indeed. So on the TDS side, when it comes to particularly tax deducted source from payments made to residents, we have currently almost 37 different provisions for different types of payments and categories of payments, for each of which there is a different rate of TDS, different threshold limits, and so on and so forth, making the law quite cumbersome. Given the way the government has been moving to simplify the law, make it clearer, our expectation is that they should have probably just 3 to 4 categories of TDS. One is, of course, TDS on salary payments, which is based on the slab rates of taxes. The other is a punitive rate, which is the highest rate for earnings from lotteries, gambling, and so on, which is 30% TDS. And then there could be maximum 1 or 2 rates for TDS, and all payments should be covered within these 1 or 2 categories, so that there is no dispute, uncertainty, ambiguity as regard which category a particular payment falls under. And the compliance also can significantly reduce. So both litigation and compliance reduces. Now, again, there, one of the points that we are looking at on is, in certain cases, the TDS is as low as 0.1%, probably because at a time when they wanted to track certain transactions, it was important to deduct TDS at 0.1%, not so much as a tax collection mechanism, but to ensure the transaction is tracked by the tax
Yeah, that was only for reporting. That was
Correct.
only for a reporting mechanism.
Now, yeah, exactly right. Now what we are saying is, wherever a transaction is covered by GST, it is already being fully tracked. And therefore, at least for those cases, remove this 0.1% TDS, because it results in significant amount of compliance for corporates and for businesses. And that's therefore what our ask again is, an expectation.
But that mapping between GST and direct taxes has to be more robust in real-time basis. Only then that TDS provision can go, is what I personally feel. Because as you rightly said, a lot of these rates are only for reporting, not merely a tax collection tool, and that government has been talking about also very openly that these are only for reporting, so that's why it's just 0.1%.
And increasingly,
So
Timsy,
something
they
on that
are
side is
tracking. Yeah. Sorry, Timsy. Yeah, so increasingly the government
on that side I
has
feel.
the government has
Continue,
enhanced its
please.
digital agenda and is now tracking direct and indirect taxes pretty well. In fact, in many cases, the reconciliation that is sought for creates a lot of questions itself, which is a subject by itself. But yes, therefore, now a lot of tracking from a GST standpoint and reconciliation between direct and indirect taxes already started happening.
Ah. I'll stop you there and I'll go to Saurabh now on something that Finance Minister herself has spoken about, and she said that that will be her priority for the upcoming budget. That is custom tariff rationalization. Rationalization now on the custom side. We've seen GST rationalized. We've seen direct tax regimes rationalized. Customs is still waiting. And again, we saw some rationalization happening last year as well. We saw some tariff lines going and only a limited were kept. What sort of a rationalization can actually happen? Can government do that? Something on that, Saurabh.
So, Timsy, rate rationalization we have seen in GST, the government has been able to actually bring in that particular change, which was much sought of by the industry. When we look at the customs rate rationalization, I think the focus of this government has been around manufacturing. It's about Atmanirbhar. Not just Atmanirbhar, we are moving towards Bharat Par Nirbhar is what the focus of the government is. If that be the focus, while production-linked incentive schemes has been able to push the manufacturing agenda, what the industry today wants is that along with the production-linked incentive schemes, which have been rolled out in around 19 to 20 odd sectors, with the overall, you can say, revenue outlay of 2.8 lakhs to 2.9 lakh crores approximately. Until financial 24-25, they have factored around 25,000 crore, which they'll be dispersing during this financial 25-26. I think the focus of the government should be to divide a particular, look into a particular sector, divide the material into finished goods, intermediaries, and raw material. The finished goods should be made subjected to a higher rate of duty, intermediaries in a medium rate of duty, and raw material at a lower rate of duty, assuming that the raw material is most tough to manufacture. Now, if that be the case, we have seen in the mobile phone industry, what has happened? Over a period of time, they increased the rate of duty on mobile phones in order to ensure that they develop a manufacturing into the country. And thereafter, once the manufacturing got evolved into the country, they brought down the rate of duty in order to ensure it is a level playing field for a foreign manufacturer as well as an Indian manufacturer.
I'm sure Finance Minister is listening to this, and she's definitely wanting to give a level playing field to the industry, be it on the custom tariff side or on the PLI side, and especially on the direct tax side. Well, time for a short break, and many thanks. So those were some of the key highlights of the budget wish list of Ernst & Young. But yes, time for a short break. Coming up next, India Inc. urges the government to make special economic zones more lucrative. Call for relief on customs duty front, among others. A special discussion up next, right after the break. Welcome back. You're watching the Budget Countdown. A more lucrative SEZ ecosystem has been a constant ask of the industry. Under existing rules, domestic manufacturers can freely supply raw materials or inputs to the SEZ units. However, when they try to buy finished goods or semi-finished goods from SEZs, the transactions attract duties. Industry has sought changes to the current law, which would make it easier for the Indian manufacturers to buy goods from SEZ units. Well, joining us now to take this discussion forward is former Chairman CBIC Najib Shah and Anurag Sehgal, Principal at Pricewaterhouse. A very warm welcome. Let me begin with Anurag first and then come to Mr. Shah, because the industry is demanding that SEZs have been in talks and they are expecting the government to bring in some change, considering that they've seen a slew of FTAs being negotiated. There is a demand that SEZs should now be made more lucrative, continue their economic viability, where duties should be a little more relaxed or more attractive, if not reduced to nil, on direct selling within the country. Anurag, what is the ask and why are you asking for this, or why is the industry asking for this for that matter?
Thanks, Timsy. And very rightly said, the industry is demanding easing of fiscal norms from SEZ for DTA transfer. And also rightly said that this is in the context of the slew of FTAs being signed for India. What industry realizes is the government of India is very clear on three policy objectives: make in India, export from India, and deepening value addition and R&D in India. Now, for that, industry is wanting that SEZ should also be realizing their full potential. And to realize their full potential, what industry is asking is, one of the earlier asks, which was there in the Desh Bill, the Desh Bill, which has not moved forward. And the ask was that when you transferred manufactured goods from the SEZs to the DTA, the duty, customs duty, should be paid only on the duty foregone amount on the goods which are sourced from abroad. Now, that is the ask which will bring SEZ units also back in the game from the perspective of domestic manufacturing for the domestic market. That is the ask of the industry. And clearly the ask of the industry is in the context of government's stated policies, which I just mentioned: Make in India, Atmanirbhar Bharat, deepening value addition in India. So clearly it is in that line what industry is asking from the government.
Coming to Mr. Shah on this demand, sir, do you think that this ask is actually valid? There is merit in this ask, and can government take that hit? Because SEZs were launched with the concept that they are only export-oriented.
Look, I think the purpose of an FTA is very different from why SEZs were instituted in the first place. FTAs seek to, cut down tariffs, eliminate tariffs, give access to market. But the fact of the matter remains that exporters under the FTA have not been doing exactly very well because of the challenges of infrastructure, logistics, etc. Here you have created a territory within your country which is said to be free from these constraints which have come in the way of exports. So SEZs have been created as little islands, oases within the country where none of these rules and regulations will apply because they get everything duty-free. Now, be it imports, be it any domestic procurement. That being so, the fact of the matter remains that whatever they produce or manufacture is primarily meant for export, and they've not been doing too badly. Last year, I just checked up the numbers, they have done around US dollars 172 billion. So they've not been doing badly. So they can supplement the FTAs in that the FTAs open the markets and the SEZs can exploit those markets by making export products competitive. So no, I do not agree with this ask of the industry that FTA imports, FTA domestic clearances should not be subject to duty merely because FTA imports are also having reduced tariffs.
Well, Given this viewpoint from Mr. Shah, coming to you, Anurag, considering as Mr. Shah explained that they haven't done that badly, so the performance is decent enough, and that might nullify the ask that they need to be made more lucrative. So why do you want to continue, or why does the industry still want to push this particular demand when the performance is decent enough? I mean, 142 billion is not bad at all, to be fair.
Totally, Timsy. It is. I won't say that the performance of SEZs have been bad, but the context has changed. Context has evolved over the decades. The SEZs came into existence, and we have to realize that these are not special export units. These are special economic units. So when special economic zones are being talked about, the reality of economics, the reality of changes in the economics in the past couple of decades has to be taken into account. And one of the realities is that India is wanting to go higher up in the value chain, manufacture more and more, contribute to the domestic economy as well as the export sectors. And for that, why to restrict any of the section of the economy from the manufacturing competitiveness, which economy at scale brings, which SEZ brings. And that is the reason the industry is asking that thank you allow us to export, but please allow us to process and supply to the domestic industry also at a reasonable cost. So the idea is to...
I'll stop you there and also take you to the Desh Bill. The idea of Desh Bill was to replace the SEZ Act. And a lot of changes were proposed on somewhat similar lines, not on the duty side at least. But yes, when it comes to that, SEZs were an older concept. Now they need to be replaced with a new bill or a new act, to be precise, to make them more attractive, more viable. What is the difference that you are looking at from the draft of the Desh Bill that you want the government to consider now? Because Desh Bill was also a proposal in the union budget itself. However, it is still stuck, I agree.
Sure. So, Timsy, from the industry perspective, if I can summarize Desh Bill, I would mention there are two basic premises on which Desh Bill was focused. A non-fiscal premise, wherein you had procedural and regulatory ease for the industry, and a fiscal premise, which allowed for manufacturing not only for exports but also for the domestic market. The argument which we are advocating now. Government is already showing the intent to carry out both the objectives, both the premises of the Desh Bill. If you notice, last year, mid-June, government carried out regulatory and procedural ease by amending some of SEZ rules. For example, for priority sectors like semiconductors and electronic components, the contiguous area requirement of 50 hectares was reduced to 10 hectares. So government is already inching towards, the procedural ease. If government goes towards fiscal ease also, I guess the intent of the Desh Bill will be met. So whether or not Desh Bill, which has been stuck, sees the light, the industry gets benefited. The intent gets materialized. And that is what industry is looking forward to contribute to Make in India.
Coming to Mr. Shah on this point that a lot of the changes that are coming in or were brought in the SEZ Act, basically the land rule, because getting a contiguous land was a major issue for the industry, and that government also realizes, because part of its responsibility lies on the government also on land acquisition. So how would you counter the industry's view if you think that SEZ should continue the way they are?
Look, the purposes of why an SEZ created has not been obliterated. It's still been created as an economic zone, undoubtedly, as Anurag has mentioned, but with an aim to promote exports and, more importantly, to ensure there's a parity between goods which are brought in there and cleared into the domestic area and the goods which are manufactured within the domestic area. That's a key requirement, really, that there should be parity. Merely because I have got goods produced in the SEZ and it's going to be cleared in the domestic tariff area, I should not get the benefit of lesser tariffs because you have been given a lot more benefits which the domestic industry is struggling to get. Better infrastructure, better facilities, lesser requirements of law, lesser procedural requirements. So you have got a whole host of benefits. Exploit that and compete with the domestic sector also on the same footing, not on a priority footing where you start getting lesser tariffs. So anyway, we'll see how this all pans out.
So that's very critical that the taxman continues with the tax perspective and says that enough has been given from the government side, enough of benefits given. So why not then reap that is the interest that they were looking on, that is the revenue collection. So the taxman is not willing to let go the revenue that he looks at from these units if you are actually wanting to do the direct selling. Well, a tough ask and a tough call for the government is what it looks like, because if a former taxman continues with that view, I'm sure the current government would definitely have this view in its mind. And yes, they must be looking into your demands as well. And with that, it's a wrap on this special broadcast. Thank you for watching. Up next, a lot more on the other side. News continues here.